Hello there, I'm Dr. Abeysekera. One of the learning goals in this workshop is for us to understand how to consolidate parent and subsidiary at a later date of acquisition. Here we are taking 1 year after the date of acquisition. Let's take John acquiring Sarah. John paid $700 to acquire Sarah, and Sarah sold $700 of equity, which is 60% of the fair value of equity. John then recorded a journal entry in John's accounting information system: debit investment in Sarah 700, credit cash 700. Sarah recorded in Sarah's accounting system debit cash 700, credit equity 700. Now that we consider both entities are a combined entity, economic entity, then these two journal entries are invalid journal entries because they are within the economic entity. Transactions cannot be within the economic entity. So let's combine the two journal entries: debit investment in Sarah 700 and credit equity in Sarah 700. So this combined journal entry should be eliminated. It is eliminated by reversing as a consolidation journal entry. Now there's more to this. There's a plan that is recorded at cost by Sarah, but it has not been adjusted to fair value. So we need to, in group accounting, we need to bring it to the fair value, and the remaining useful life is 10 years. So we need to follow 3 steps. First, ensure that all subsidiary assets and liabilities are measured at market value. And 2, eliminate the fair value of equity in the subsidiary against parent's investment. And 3, look whether parent has paid more than the fair value of net identifiable assets in subsidiary. Bring it to fair value adjustment. Plan has to be increased by 100. It was recorded as 300 by Sarah, but for the group it is 400. Debit plan 100, credit revaluation surplus 100. Tax implication of that is we debit revaluation surplus 30 and credit deferred tax liabilities 30. That is because the carrying value of the plant is now greater than the tax base by 100. We apply 30% of that. So the economic entity is richer and will have to pay taxes. But here it is the deferred tax liability we are taking. Economic entity actually doesn't pay taxes, legal entities do, but for accounting purposes we take this as a deferred tax liability, as a future liability. Now that we are preparing group financial statement after 1 year, this asset that the group has revalued has been there for 1 year, and we must add depreciation for this revalued amount. Subsidiary has not done it for this amount. For this excess, subsidiary has not done it. Group has to do it. 100 divided by 10 years useful life 10. Debit depreciation expense 10. Credit accumulated depreciation 10. When we increase the expenses, profit decrease in the group, That means income tax expense decrease. So we credit income tax expense into 30%, 3, and then accumulated depreciation means the value of the asset is gradually decreasing. So we must decrease the deferred tax liability that resulted from that revaluation. Now that value is decreasing. So 30% of that, of 10 is 3. So debit depreciation expense 10, debit depreciation expense 10, credit accumulated depreciation 10, debit deferred tax liability 3, credit income tax expense 3. Now we do the third entry, step 3, elimination of investment, and trying to find out step 2 and 3, and then find out whether there's goodwill. So we reverse the investment. And Sarah's equity that was purchased at that time was 1,000 into 60%, 600. Here it is. And then revaluation surplus, Sarah has not done it, group did it for Sarah, is 100 minus 30, 70 into 60%, 42. That is part of Sarah's equity to bring that into market value. But this is 642 together. That means John paid more than that for an asset unidentified but has value, and that is called a goodwill. Could be a collection of intangible assets. It's goodwill. 58. Debit goodwill 58. Debit Sarah's equity 600. Debit revaluation surplus 42, and credit investment in Sarah 700.